Australia's central bank is expected to hold rates for a third straight meeting. Even as traders bet, the Fed will deliver its third consecutive cut later this week. We'll examine why global central banks are diverging, with the RBA on track for one of the shortest easing cycles in the developed world. Live from Singapore, this is Insight with Haslinda Amin, and here are the other top stories. President Trump clears Nvidia to ship its H200 AI chip to China with a 25% surcharge, a move that could restore billions in lost sales for the chip maker. But the question remains, does China even want the chip?
I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market. I mean, none of them are particularly great friends of mine.
Trump is trying hard not to show whose side he's on as Paramount launches a hostile bid for Warner Brothers Discovery in order to win investors away from Netflix's offer. HSBC Asset Management's Geoff Lunt will be joining us with his outlook as investors take a more cautious stance on U.S. stocks while eyeing a bigger push back into Chinese as well as other Asian markets. Also ahead, we discuss whether Hong Kong's luxury property market is finally bouncing back as an apartment sells for a record $113 million. Knight Frank's Christine Lee will be joining us to discuss that and other hot property trends. And here's a quick check on the market. Stocks in Asia under pressure this morning, extending declines from Wall Street overnight. That's as traders grow anxious about the pace of easing by the Fed beyond this week's near-certain rate cut. U.S. Treasury yields also in focus after climbing to the highest level in more than 2 months. We're also monitoring Australian assets, with the RBA expected to hold rates in about 30 minutes from now. We'll also keep an eye on Japan's 5-year bond auction results due later this hour, as it remains a favorite duration to short for aggressive traders. We're also watching Asia chip-related names after President Trump granted Nvidia permission to ship its H200 AI semiconductors to China. That's in exchange for the U.S. getting a 25% cut off the sales. For more, let's bring in our Asia tech correspondent, Annabelle Drulis. And Belle, it's the green light for Nvidia, but only for approved customers in China.
Yeah, that's right. So only select customers will be able to buy these H200 chips. But I think the real key question out of this is what's going to be the policy response from Beijing? Because President Trump announced the move on True Social overnight, and he said that he had spoken with the Chinese president. He said the Chinese president had responded positively, but we don't really know what it means at the end of the day for the company. For Nvidia, this represents a multi-billion-dollar opportunity, and we know that. And it's also interesting because China's been completely removed from any revenue estimates. We saw that in the latest earnings. But yes, in essence, they can now, at least from the US side, sell these H200 chips into China. Now, previously, they've had the H20. That was from the same Hopper series that was specifically designed for the mainland market. H200 is a chip that was only on sale or was on sale in US markets abroad as late as last year. I mean, this year you've moved into the Blackwell architecture. Next year you ramp up into the Rubin architecture. So China will still be a couple of iterations behind. But this is the most powerful and the best chip that China has been able to legally access so far. And it's especially well suited for inference as well. Inference is the deployment of AI technology, and it's really going to be essential as businesses and whole industries also start to integrate AI technologies. So big pushback as well as you can expect from the Democrats in the US, who are saying that really President Trump has gone way too far with this and is ceding any sort of leadership possibly to China as well.
Of course, for them, it's about national security. Meantime, Belle, President Trump has also signaled he wants to do away with state-based rules on AI.
Yeah, that's right. So, again, this was a post that he made on True Social in the last few hours, but talking about his executive order that he plans to sign around AI rules. So AI rules have been becoming very state-based in the US, and it's become very difficult, really, or that's the complaint of a lot of big tech companies, is essentially you're getting restricted or regulated in different states, and it changes, and then it makes it more challenging, essentially, more red tape, more complex, the operating environment. And so President Trump is essentially saying they want to cut through that. They want to have one rule book, and he will lay out this executive order later this week. So we actually have seen a draft of a potential order at Bloomberg News. We saw that in the last few weeks. And it does say that it would give the DOJ the capacity to sue states over AI regulations it deems to be unconstitutional. It could also threaten funding cuts to states with laws that are considered too burdensome or restrictive. So the path is very much clear here that the US is looking to ease the rules essentially for big tech, and the key question here and the key push from a lot of the lobbyists from the big tech side has been that the less red tape you have, the better it is for them, and the better it helps the US, again, compete against the likes of China.
Belle, thank you so much for that. Our Asia tech correspondent, Annabelle Drewlers. Let's get perspective from Dilin Wu, research strategist at Pepperstone. Dilin, good to have you with us. Whatever the AI rules, it does seem like AI remains a theme for 2026. The question really, how do you play it best? I mean, now we're getting indications that, Trump is greenlighting H200. Perhaps Chinese AI plays are the way to go.
Well, actually, is a good question. And for against this backdrop, I would say I would remain constructively selective. And in equities, I would still favor high quality growth, especially AI infrastructure, semis and cloud companies with strong balance sheets and also genuine pricing power. But selectivity matters. Because the AI theme is getting increasingly crowded, and for the US equity, we're seeing the market split into two camps, OpenAI and Nvidia camp, as well as Google camp. So I would say so far the former has underperformed while the latter has been shining. And this week's Oracle and Broadcom, aligned with these two camps, are set to report earnings, and their result could have a significant impact on Nasdaq's performance for the rest of the year. And for China, I would say I would still look into Beijing's respondent, and also the China will quickly move into the season where the Central Economic Work Conference will happening, and if they give further guidance to develop in AI infrastructure and build some of the domestic kind of chips, then I think it would be an extra plus for the Chinese equity and the AI session.
Is it enough for global investors to gravitate more towards Chinese AI plays, pull back from the Max 7? In my conversation with Ed Yadani just yesterday, he talked about underweighting the Max 7.
I think it's one of the reasons that the bond yield is still above 4% in the U.S. is, the debt situation, there's nothing that we're doing to improve it. It's the bond vigilantes who basically say, well, if the Fed's not going to maintain law and order in the capital markets, they're going to do it. And so far, the Fed's attempts to ease have been offset by what the bond vigilantes have been doing.
Of course, Dilin, we had Ed Yadani talking about the yield situation, how they're rising compared to about just a year ago, despite the fact that the Fed is cutting rates. First off, let me just get your reaction from, on the AI space. Is it time to pull back from the Max 7?
Well, I think we obviously see the Magnificent Seven are struggling a bit, especially for Nvidia performance over the couple of weeks or months. And I feel like we can consider something like to adjusting our position to relatively smaller names like Broadcom. I think they have relatively competitive advantage compared with the high valuation kind of Max 7 names. I think that is obviously a strategy we can potentially consider.
And when it comes to the bond market, we're seeing anxiety just by looking at 30-year yields. I think there is apprehension perhaps that, yields should actually be lower given that the Fed is on an easing cycle. What's your reading on what we're seeing in the yield space?
Well, I think for the Fed rate cut itself, the market has pretty much fully priced in a 25 basis point cut on Wednesday, and this move is likely to be framed as the risk management steps. So the real focus isn't the cut itself, but it's the dot plot and also Powell's language down the road. And also, I think people are considering about a potential inflation stickiness down the road, given, like Hassett, who's the potential next Fed chair, is leaning towards more of the dovish side. And if this is the case, then it will naturally boost the long end of the U.S. equities returns. And I think that potential is the most important concern that markets are looking into.
Might that concern send 30-year bond yields beyond 5%? Might 5 perhaps be the lowest we see for 30-year yields?
Well, I think it really comes down to the Federal Reserve's next move or its potential rate cut path. I mean, the market is currently pricing in the next 25 basis point rate cut following the December meeting in that April to June range in 2026, October to be the second next. But the pace of those moves is still up in the air. It's going to hinge heavily on how much the labor market cools and whether service inflation sticks around. Personally, I say the Fed will still put a lot of more weight on employment itself. So unless we see a clear picking up in inflation, a hawkish pivot looks pretty unlikely. So I would say if, the Fed just postpone the next cut to the second half of 2026, then there's certain probability that we can see the 30-year yield to surpass that 5% mark.
Dilin, what's the outlook for the S&P on the back of that? We've seen double-digit growth for the last 3 years. What's the pace of growth for the S&P in 2026, you think?
Well, in general, I would stay optimistic about the S&P 500. As we just mentioned, both the S&P 500 and Nasdaq delivered a great performance, not only in 2025, but back to maybe 2022 till today. So in general, I think the Federal Reserve is due in its easing cycle, and we are expecting, more potential fiscal stimulus, especially when we're heading into the midterm selection. So potentially Trump will release more stimulation measures in the upcoming year. So I think these are all the bullish factor for the S&P 500 itself. But I would be cautious as well. So I would specifically look into the CPI numbers to be released. If we see the inflation start to tick up, then a potential discussion of the next move is a hike being brought up, then I think it will put some extra burden on the U.S. equity market.
And of course, there's a potential that we could see some hikes for other central banks as well, the likes of the ECB, the BOJ, even the RBA in 2026. Should the playbook in 26 be different from 25, taking that into consideration?
Well, I think actually for 2026, the big theme will be divergence and volatility rather than a single or a straight line continuation of the 2025 rally. I mean, the biggest shift in my view is exactly that the global rate cycle will no longer move in one direction. Instead, we're entering a multi-path policy environment where the Fed, the ECB, the Bank of Japan, and many other central banks may all move at different speeds for their different reasons. That alone creates a very different backdrop for risk asset compared with the last 2 years or the last year and a half. And markets are shifting from simply reacting to data to actively pricing in this growing policy divergence among central banks, and this will naturally widen performance gaps across assets and regions, I think.
Dilin, we're awaiting, of course, the RBA decision at the bottom of the hour. Markets anticipating the RBA to stand pat for a third time round. I'm just wondering, what messaging do you see from the RBA for the coming year?
You're right. RBA is widely expected to keep rates on hold this time. And if we're not looking into any rate cut anymore, then naturally we will move to the next question, which would be when to hike. And I feel like the market is currently pricing in about 9 to 10 basis point hikes over the next 12 months. Not enough for a full 25 basis point move, but the shift in sentiment is still quite important. And I feel like the May meeting next year will be a live one with roughly a 50% chance for a hike, while the first fully priced 25 basis point move is expected in August. I think, since there's no meeting in January or March, I see the February meeting as a prime communication point, and this meeting would be somehow still a bit early. And by then, I think the RBA would signal that the rate cut cycle is somehow essentially over, though they'll likely maintain flexibility if incoming data warrants it.
Dilin, hang tight. Dilin Wu, research strategist at Pepperstone, is staying with us. When we come back, we'll discuss Paramount's hostile cash takeover bid for Warner Brothers, days after the studio agreed to a deal with Netflix. More to come on Insight. Keep it here with us. This is Bloomberg.
Today's move was entirely expected. We have a deal done, and we are incredibly happy with the deal. We think it's great for our shareholders. We think it's great for consumers. We think it's a great way to create and protect jobs in the entertainment industry. We're super confident we're going to get it across the line and finish. So we're excited.
Oh, I know the companies very well. I know what they're doing, but I have to see what percentage of market they have. We have to see the Netflix percentage of market, Paramount, the percentage of market. None of them are particularly great friends of mine. I want to do what's right.
Some comments from President Trump and Netflix's co-CEO Ted Sarandos after Paramount launched a hostile takeover bid for Warner Brothers at $30 a share. Now, that bid, valuing Warner at $108 billion plus debt, it comes days after the storied Hollywood studio agreed to a deal with Netflix. Paramount's bid compares with Netflix's offer of $27.75 in cash and stock for an enterprise value of just under $83 billion. Paramount's offer is for all of Warner Brothers, while Netflix's offer is for the Hollywood studios, HBO, and streaming business. Dilin Wu, research strategist at Pepperstone, is still with us. And Dilin, it is about scale. As it stands now, who has a better chance of getting that deal?
I think honestly, this bidding war is turning into one of the most dramatic M&A storyline we've seen in years. And I think from a market perspective, I think it's really it really highlights two things. First, the strategic desperation in traditional media, and second, Netflix's initial offer was already reached, but the market clearly doesn't buy into the idea that Netflix will escalate this into a true bidding war. Traders or investors hate the execution risk and the debt load involved. That's why I think actually Paramount currently looks more committed to walking away with the price. And I think in my view, the dynamic from here will hinge on how the WBD shareholders weigh valuation versus regulatory risk. Paramount's offer is cleaner and also easier to approve. I think Netflix bid is more transformative, but the regulatory path is quite messy. That's why the stock is trading below both offer prices. The arbitrage market is basically saying the story has a lot more to twist.
Well, we heard from Netflix's co-CEO expressing optimism. Given Paramount's offer, how far is it willing to up the ante? How far do you think Netflix is willing to go?
Well, I think actually from this case, Netflix share just dropped, and that drop speaks volumes. I mean, Netflix investors are sending a very clear message here from my personal perspective that we don't love this, and I don't blame them. I mean, it's an $83 billion bet with a massive bridge loan and huge integration risk. Media mega mergers have a poor track record, and Netflix shareholders obviously know it. And I feel like if Paramount end up winning, Netflix probably rallies hard because the market would breathe a sigh of relief that Netflix avoided a high risk deal and avoided potentially paying a $5.8 billion breakup fee for nothing. And I feel like right now Netflix is stuck in the worst spot. Their bid is on table, and they are in exclusive talks, and they might still lose. I mean, that's why the stock reaction makes sense. Shareholders don't want to see Netflix chasing this deal higher. And in my view, if Netflix is serious about winning, then they will have to sweeten the bid. But the shareholder basically is clearly not enthusiastic about that.
Dilin, how are regulators looking at this? We had the likes from Elizabeth Warren expressing how such deals are empty competition. How might the regulators be looking at this deal?
Well, from where I see, the regulatory overhang is massive, I would say, and is the single biggest reason the WBD is trading at a discount. Actually, for Netflix, the antitrust risk is very real, I would say. You're talking about the world's largest streamer buying HBO and Warner Bros. The government simply cannot ignore that level of concentration. I wouldn't be surprised if the DOJ pushes this right up to the court. And I mean, it will be quite similar to the 2018 AT&T and Time Warner saga. And I feel like Paramount's deal is a bit smoother, but not a free pass as well. They still face scrutiny, but let's be very honest, the potential wins, the political wins matter. The Ellison family's influence and Jared Kushner's support could make the process less painful. Let's put it that way. So in my view, the market is assigning a higher probability that the Paramount clears the regulatory bar first. But for both deals, the timeline risk is huge. You could easily see the dragging well into late 2026. And for any event-driven investor, that's a serious cost of capital to consider.
Dilin, would it be a buying opportunity for any of these stocks, considering it's going to be a messy process before we get to a resolution quickly in 20 seconds?
Well, actually, it's a great question. So to me, the discount in the BWD is a very clear message. Investors think the deal is far from down. And the regulatory noise is only one piece of the puzzle. The other part is simply time. So even if you believe one of the deals eventually wins approval, parking capital for months, maybe even a year, comes with real opportunity costs. So for traders, I think WBD is now a two-way setup. So if you think the deal collapses, you are looking at the potential unwind back towards maybe $20. And if you think Paramount sweetens its offer or Netflix counters, you've got upside towards maybe $27 to $30.
Dilin, thank you so much for that great perspective. Dilin Wu, research strategist at Pepperstone. Coming up, the RBA rate decision is due in just minutes with a hold expected, but traders bracing for any hawkish commentary. UBP will be joining us for an analysis. This is Bloomberg.
With the RBA, I think it's almost certain that the RBA will be keeping rates unchanged.
But we're trying to figure out whether these price pressures are temporary or whether they're more persistent and permanent. So I think they're going to require a couple more months of data to actually determine whether that's the case. And for that reason, we don't think that they're going to jump the gun and actually signal an hawkish bias.
If the projection of RBA is correct, where inflation will not see its peak until perhaps late in first quarter next year, then we're pretty much set for potential review of a potential rate hike in 2026.
some of our guests sharing their insights on the upcoming RBA decision coming any moment now. We're tracking Aussie assets on the back of that weight. The ASX 200 index under pressure, like the rest of the region, by the way, down about 0.4%. We've been keeping an eye on the Aussie dollar versus the Kiwi in particular. It's had a stellar run, up about 8% year to date. The question really is the outlook versus the USD. And we have that decision from the RBA, keeping rates steady, unchanged as expected for a third time round, third straight meeting, pretty much because we have seen how resilient the economy is. We have unemployment also pretty stable. The question really is where inflation goes from here. Lots of expectation that if the economy remains strong, we could see the RBA shift its position. We could even see that rate hike in 2026. So the messaging from the RBA later on when it talks to the media is crucial in terms of messaging from the RBA and what it sees itself doing in 2026. Let's get insights, perspective. Ignatius Pang, Asia. Let me get Ignatius Pang's credentials is with us. UBP head of APAC sales and Asia is with us for that assessment. So no change, pretty much expected. It is what it does in 2026 that is crucial.
Exactly. Thank you very much. Yes, they have left rates unchanged at 3.6%. I think the very important focus right now will be Bullock's guidance for 2026 as well, and what they are really going to focus into as a guidance to where they would decide into hiking rates as well. I think if you look at the RBA's policy path in the past, they were the last to start cutting rates, but this time around they could be the first to actually start hiking rates within the G10 space as well. Now this is creating a lot of very interesting, I think, price action, especially for Aussie dollar crosses and on the Aussie dollar, and especially as we go into year end, I think the markets will start to speculate into the number of rate cuts or hikes that are coming from each G10 central bank as well.
Ignatius, we have several headlines already from the RBA. It says that it is appropriate to stay cautious. It will update its view as the data evolves. It also talks about how measures of labor underutilization remain at pretty low rates and that uncertainties about the outlook for domestic economic activity. So there are uncertainties out there, but so far the economy has been resilient, and if it stays resilient, expect that rate hike.
That's right. So I think the resilience in a lot of areas in Australia, especially number one with a tight labour market, and number two also with a very stubborn profile for inflation at 3.8% year on year. I think these are basically the reasons why the RBA's hands are pretty much tied at the moment to cut rates, and also I think they have also been very cautious in their approach over the last few meetings as well. That I think will be a very important point in supporting any drop in the Australian dollar. And and on that front, I think we will probably anticipate the first rate hike if, like has been mentioned, if the inflation data continues to be sticky into the first and second quarter of 2026, I do expect that the third quarter 2026 will bring in the first rate hike from there.
Which crosses in particular are you looking out for? Because versus the Kiwi, what a stellar run. 8% increase year to date, one of the biggest increases in years.
Yes. Aussie Kiwi is a very interesting pair. I think it's very much hinged on the interest rate differential between or divergence in policies between that of the RBA and the RBNZ, and that explains the run up we have seen in Aussie Kiwi, particularly with the RBNZ having cut rates consecutively. But it was rather interesting in the last meeting that they did mention that they're probably at the end of the cutting cycle. So we do expect a little bit of correction there on Aussie Kiwi, possibly within the new wider range of 1.12 to 1.16.
What would be interesting would be Aussie dollar at a time when, we're expecting the RBA to hike rates in 2026. The Fed would be cutting rates.
That's right.
Where do you see the cross headed?
We actually do see the Aussie dollar heading to 0.72 in December 2026. And on that front, I think that will encompass about a good 6.5% gain from where we are right now. Clearly, I think the interest rate divergence between both central banks would be a clear driver in that currency pair as well. But having said that, I think the interest rate profile for the Fed is also a little bit uncertain, although we are mostly priced in for a rate cut in tomorrow night's meeting. I think the bigger question is where would Powell actually draw the dot plot into 2026? I mean, so far the market's pricing 1 rate cut from the Fed, but the overnight index swaps are actually pricing 3 to the extent of 3.25 by the end of 2026. So it will be a very volatile profile for the Aussie dollar into 2026, and we do see opportunities to load up into the Aussie dollar on the dips.
Truth of the matter is that inflation remains sticky for just about every country. I mean, we have the RBA saying the recent data suggesting that a risk to inflation is tilted to the upside.
That's right.
And it's also tilted to the upside for the US. I mean, some say that, it's going to stay at 3 for a very long time. I mean, how are you looking at the inflation outlook for the US in particular, how that might play out into the dollar and what the Fed does from here?
I think it will be a two-pronged strategy for the Fed. It will not just be about inflation and guiding their decision. It also will be on the labor market. And as we have seen in the last ADP report, there was a negative reading of minus 32,000 and something that has rung an alarm bell for the Fed as well. We do think that the focus will be more on the labor market rather than on inflation for the Fed to start cutting rates as well. And for that,
but it's a dual mandate Fed.
Yes.
It does seem like the Fed has chosen instead to be looking at the labor market as opposed to inflation. Is that a fair assessment? And is that what's worrying the bond market?
I think that would be a bit worrisome there as well, and especially when the next Fed chair is a bit uncertain at this point of time. And his character will be actually a guiding point for the markets in terms of where the Fed will be focusing on. Will it be inflation or on employment, and where the number of rate cuts will come from the Fed in 2026 as well.
What assumptions are you making for the path of the dollar in the next 12 to 24 months?
Well, assumptions can be built back on historical performance as well. If we try to draw a little bit of parallel back into Trump's last presidency, we did see the same 8 to 9% drop in the dollar at the onset of his presidency, and then we did see a consolidation in 2017 as well. So we do think that it's not, although structurally we are expecting a long-term weakening trend in the dollar itself, we do not think that it's a one-way bet. From what we have seen in the price action this year, it has been a highly consensual trade, but with fraught with low conviction as well, based on the recovery of the US dollar. So that means that we are in quite a bit of a volatile path for 2026 in terms of the US dollar in general.
So expect volatility in the FX space basically for 2026, right?
That's right.
I mean, the other currency we're keeping a very close watch on is actually the yen.
Yep.
Expectations, the bet is that the BOJ will move, but how much? And, some like State Street suggests that the increments of those rate hikes could be smaller than the market anticipates. What's your own take on that?
We are also along the same line as well. I think since the start of the year, a lot of us on the street have been calling for a stronger yen profile as well, and of course this did not play out. Number one, I think what we did identify was that the speed of compression between US and Japanese rates were just not fast enough to warrant a massive strengthening of the yen. And now with Takaichi as Prime Minister of Japan, I think this has also set the stage that we are probably going to be seeing more of a range-bound move in dollar yen in particular. Yes, the BOJ will likely hike rates in its December meeting, but again, its forward guidance will be very important to, especially for markets speculating on the number of rate hikes coming from the BOJ in 2026.
And we've been keeping an eye on the 5-year JGB auction on the back of that pretty solid 10 and 30-year auction. The Japan 5-year bond bid cover ratio is 3.17 versus the 12-month average of 3.64. So the bond sale sees weaker demand than the 12-month average. So it has broken away from the 10 and 30. What's your take on that? This has been a favorite bet for those aggressive traders.
Particularly on the 10 years. We're currently about 1.7 to 1.75 on the 10-year JGB right now. I think the tepid demand on the 10-year curve itself, the 10-year JGBs, has also been one of the reasons why we have been seeing a weaker yen profile as well. We do expect, especially on the shorter end, to see a bit more volatility on the JGB yields on the shorter end, but bigger focus will be on the 10-year JGB yields. Yeah.
I guess the situation and the picture for JGBs has changed. There's been a lot more interest.
Yes.
Your retail investors are also in on it. I mean, does that change the picture and the appetite for JGBs going forward?
Oh, yeah, I would think that in terms
There's
of...
greater liquidity now.
There's greater liquidity, especially from the offshore market as well. That kind of flow is actually what has been a strong driver for dollar yen, particularly. The demand for JGBs, I think, will also be very much a function of the confidence in the Japanese economy, especially, or the Japanese government, especially managing their fiscal positions as well. I mean, where we are in terms of the 10-year JGB, we are not very far off in terms of from the spread that is the narrowing spread is commanding against the US dollar. If you compare that to Italian bonds and that of French bonds as well. So rising JGB yields does not necessarily mean that the economy is doing well. It's also a sign that a risk premium is being priced in, especially when fiscal positions are being stretched on the
How concerned are you about the fiscal spending plan for the government of Takaichi?
It's comparatively, if you look back to what the spending plan was as well at the outbreak of COVID, we're not there to that kind of scale. Not that concerned. I think the Japanese have managed to manage their finances very well over the last decade itself. And I think that usually this kind of dislocations in JGB yields and the actual fiscal positions of the government tend to be temporary as well.
All right. Yeah. So if you had to give projection by the end of 2026, where do you see JGB yields for 10 and 30? And what do you see for the yen in particular? What level, what strength are we looking at?
All right. In terms of I will focus on the 10-year. I think the 10-year we're looking at 1.9 to 2% in the next 1 year. And for dollar yen, we'll be looking at 145 as our target for next year as well.
And what will drive that? What will be the key catalyst for 145 for the yen?
Key catalyst will be the speed at which the Fed cuts interest rates. We're not expecting a lot out of the BOJ in terms of the pace of rate hikes coming from them. But I think the crucial driving force there will be on the dollar itself.
Might you be pricing in too much Fed rate cut? What's the risk of that?
The risk on that front would be, the Fed, similar to every other central bank, will be on a very data-dependent approach as well. I think the worst thing is for any central bank that you start cutting rates aggressively and realize they're way ahead of the curve and they have to dial back again into hiking interest rates. It doesn't look good for a central bank on that front. So I would say that 2 to 3 rate cuts coming from the Fed is a little bit more, I think within a year, it's a very balanced approach. Especially with the recent holdback in a lot of the US data prints, I think the Fed is working very much in the blind at the moment. Yeah.
Ignatius, before we let you go, what are your conviction calls for 2026 in terms of the crosses that we should be looking at and be investing in?
I love the Aussie, and you got me at a very good time. I think a lot of our clients or those on the street know that I love the Aussie a lot. And I think when we had the dollar debasement story, the Aussie was our key pick. In terms of its economy, the resilience, and also migration supporting retail spending as well on the consumer level. If we look at how the Aussie dollar has performed in 2025 itself, it's indeed been a laggard if you compare it to that of the euro and the pound as well. So we are still very constructive on the Aussie dollar, Australian dollar, targeting 72. But I do think that if interest rate divergences in terms of monetary policy divergence are a key driver for the Aussie dollar, I will look at other pairs, not just the Aussie dollar, but also on sterling Aussie as well.
Ignatius, great perspective. Thank you so much for joining us today. Ignatius Pang, Asia Head of FX Sales and Execution at UBP. Again, of course, we had the RBA out with a decision standing pat for a third straight meeting. Now, still to come, we're watching Interglobe shares after yesterday's $4.5 billion plunge as the government signals penalties on the way over IndiGo's mass flight cancellations. We're live to New Delhi next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Let's do a check on Indian markets as they open. In the first few minutes of the trading day, we have the Sensex currently down at 0.4%. The drop in the Indian markets pretty much a reflection of what's happening across Asia as we count down to that Fed rate decision. Keeping an eye on the rupee, currently trading at 90.07 versus the USD flat. Versus the USD. Of course, one stock we're watching is actually IndiGo. We're keeping an eye on IndiGo's parent after shares yesterday saw their biggest plunge since February 2022. The Indian government signaling it will penalize the country's largest airline over days of mass flight cancellations.
We will take very, very strict action, not only for this situation, but also as an example. We will set an example for all the airlines. If there is any miscompliance, any non-compliance or non-adherence for any single person, any entity or any organization or any operator functioning in this civil aviation, we will take very, very strict action so that we set an example in the industry.
Live to New Delhi now, and our India aviation reporter Mihir Mishra. Mihir, when the government says it wants to make an example of IndiGo, what does it actually mean?
So, the government is concerned and sees this action of flight disruptions that happened at IndiGo it feels that it was airlines' lax attitude in handling the situation. They did not act well in time to be able to address the situation, and that has led to this huge flight disruptions across the country. You remember, if IndiGo is the largest player with about 66% market share, now any disruption in their flight operations does disrupt the whole aviation ecosystem in the country. Now, the aviation ministry and the India's regulator had sought responses from the airline CEO seeking what happened due to what was the reason behind these disruptions. Now the CEO has responded giving 5 key reasons. Now those reasons include tech glitches and also the pilot shortage. Now all these, and also like some congestion in the aviation ecosystem in India, etc. Now all these replies will be analyzed, and post those analysis, penalties will be decided. Now the penalties could be cash penalty, which the DGCA or the India's regulator rules allow, or it could be some action against the management. But remember, these are all still under discussions within the government and within the regulator. There is nothing that they can do, they plan to do in the interim. All these responses will be analyzed legally to see the regulator's limit in being able to implement it. Now those discussions are on within the government.
Are there any suggestions that some heads would roll? Could the position of the CEO be at stake? Has there been any indication at all?
So there is a concern that the CEO and the top management in the airline did not handle it well. Now there is an indication that they are looking at some sort of an action against the top management, but they also know that the current DGCA or the Indian regulation rules do not allow them to directly take action against a company's CEO who sits with the approval of the board of that company. So all these they would definitely want to take an action that sets examples for all the other carriers in the industry. But these things need to be legally analyzed first before they move ahead with any such action against the top management or the airline per se.
Mihir, what are the implications for IndiGo as a company? We know that the losses we've seen so far has led to a drop of $4.5 billion in its value.
Yeah. So the first loss, of course, is the market hit that they took. The second is the big reputational loss that they have taken with this incident. Remember, IndiGo has been running a fairly tight operation for the past 19 years with no single disruption blamed to the airline. This is the first time IndiGo has seen such a huge disruption, and the fault has been found to be it is the management's fault. They were not able to manage or assess the pilot shortage better, and it led to such disruptions. So this, even at the IndiGo level, the reputational loss will take some time to recover. Passengers will try and avoid IndiGo for a brief period of time. There is no alternative to IndiGo in the Indian market because they are a large carrier, but they will try to avoid. Otherwise, IndiGo's reputational loss will take some time to recover.
Mihir, thank you so much for that. Bloomberg India aviation reporter Mihir Mishra in New Delhi. And IndiGo shares right now getting some support, up by 0.5% after that sell-off that we've seen in the last several days. Staying on India, the country's IPOs have hit a record $19.6 billion this year as companies rush to capture the booming investor demand for new shares. Let's bring in Chiranjeevi Chakraborty, who leads our Asia equities coverage. And of course, we've seen 300 IPOs this year? CJ, what's the outlook?
Well, unlike IndiGo, Indian IPO market has been flying quite high. As you can see, We did, cross the record that was set last year of about 1.70 trillion rupees raised in IPO proceeds. We have crossed that now to 1.77 trillion, with over 300 firms now listed in the Indian secondary market. And it's come at a very strange time for Indian markets, given that generally you would associate a high-flying IPO market with a high-flying secondary market. But if you look at the performance of the Indian stocks overall, it has been a dull year by global standards. As we have iterated earlier, Indian stocks are lagging their emerging market peers by the most in more than 30 years. Their Asian peers in about 27 years. So it has been a very quirky year as far as Indian markets is concerned, but the IPO market clearly is the one that is seeing a lot of bullishness at this point of time.
Is it fair to say that it is a reflection of the growing maturity of the capital markets in India, or is that too much to read into it?
No, clearly it is a sign of the growing maturity, because it's not a one-off. The Indian IPO market is now in its third, really strong year, and it just keeps getting better and better. You are seeing newer companies coming into the market, not just from the old economy, but as well as startups from the technology world who are getting listed, with one of them, Meesho, which is an e-commerce platform, getting listed tomorrow on the exchanges. So it has been a good mix of companies that are coming in, and that has driven a lot of institutional bullishness in the IPO market at this point of time.
Well, we've seen euphoria, but euphoria comes with risks, I suppose. I mean, almost half of the IPOs we've seen so far in India have done really badly.
Yeah, I mean, it seems like these IPOs hold appeal as long as they're in the primary market, and the moment they come to the secondary market, investors have not shown them much love. As you mentioned, about half of the 300 firms that have listed this year are currently underwater or below their IPO price, and which kind of bodes quite badly for next year, which is set to be another cracker of a year, given we are expecting IPOs from Geo Platforms, which is a unit of Reliance Industries, the country's largest stock exchange, National Stock Exchange of India, as well as Walmart-owned Flipkart, which is an e-commerce platform. So for all of these IPOs, one would expect that the secondary market performance has to perk up going ahead.
CJ, thanks for that. Chiranjeevi Chakraborty, who leads our Asia equities coverage. Now, still to come, HSBC Asset Management's Geoff Lunt will be telling us why or which three themes are set to dominate markets next year. And Knight Frank's Christine Lee explains why investors and tenants should be rethinking their real estate strategies in 2026. More to come in our next hour of insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Call it Fed anxiety. Asian shares under pressure ahead of the Fed's decision on Wednesday, where it is broadly expected to deliver a rate cut. Some traders are warning that the U.S. central bank may signal a slower pace of easing ahead. We're also keeping an eye on Aussie assets. They're in focus after the RBA held rates and cautioned on inflation. And we're watching Japanese yields after a tepid 5-year bond auction, unlike the 10 and the 30s. Well, Chinese assets are also in focus today after the country's senior leadership declared boosting domestic demand as the top economic priority for 2026. For more, let's bring in our Chief North Asia correspondent, Stephen Angle in Hong Kong. And Steve, what is the Politburo saying, and how should we read what policy adjustments might be forthcoming?
Yeah. Right. So we all know, I mean, according to the data and the trends right now, that China needs to rebalance its economy, rely less on exports and boost domestic consumption. And that's what's going to be the priority for 2026, at least the economic priority, given, the lack of momentum or the slowing momentum in growth in the later half of this year. And also, of course, the external environment is quite questionable, if you will. Even though the United States and China have that 1-year truce, there could be still a lot of stumbling blocks. So you have to build up that domestic economy further. But what you have is excess industrial capacity. You have persistent factory gate deflation for more than 3 consecutive years. You have households unwilling to part with their savings because of the uncertainty. You have the ongoing property mess, which has deteriorated household paper wealth. So there are a lot of challenges, and we don't have the specifics, because what the Politburo does behind closed doors is set the tone for policy in 2026. And then it's going to be the Central Economic Work Conference, a broader body to kind of put tone to policy. And then, of course, it is debated further at the National People's Congress in March. But why is there some disappointment, if you will? Because, again, it seems as though this is a continuance of the current year's fiscal and monetary policies. There's no outlays really for major stimulus, despite the momentum slowdown. And there's really no specifics on boosting consumption. Yes, domestic demand, but the actual consumption part of the equation, what are they going to do to get those households to spend more? Not a lot of specifics. And then there's no specifics really on how to continually tackle the property problems. So again, we'll wait for any readouts from the Central Economic Work Conference, which is also behind closed doors. And then, of course, we wait until the National People's Congress in the first week of March.
Steve, speaking of disappointment, in fact, Goldman Sachs says it is somewhat disappointing. I'm just wondering, what was it expecting? I mean, this is China. You can't expect big bang stimulus. We have never seen that in a very long time.
Yeah, so that Goldman report from their economists essentially, again, sort of outlined what I just said. They didn't have specifics coming out on consumption and how to boost that, or the property market, which is still a significant drag on the economy and also on sentiment, of course. But it looks as though, given the readouts from Xi Jinping and those top leadership in the Politburo, is that they're coming into 2026 fairly confident. I know the Chinese domestic economy is not humming on all cylinders, but the actual ramifications of the tariff war and the ongoing up and down gyrations, of course, of their trade negotiations with the United States, China has turned out okay. They didn't have a major crash of the domestic economy. It's steady as she goes, with a little bit more emphasis on new productive forces, AI, and the technologies that they want to encourage and perhaps bolster even further. And also, there was a key wording in there. They brought back cross-cyclical adjustments, which indicates to me and others is that that's the first time they've done that since December of 2023. That indicates there's longer-term planning and longer-term outlays in the works right now, when last year it was more about heading off the challenges at that moment, given the incoming Trump administration and the potential for those trade tariffs. It looks as though the Chinese government and authorities on the economic front are fairly confident that they can keep the ship heading in the correct direction.
Steve, great stuff as usual. Chief North Asia correspondent Stephen Angle with the fine print of that China's readout. Let's bring in Geoff Lunt, head of Asia investment specialists at HSBC Asset Management. Geoff, so no big bang stimulus, which is no surprise. But as Steve indicated, more of the same isn't necessarily bad for China.
I think that's right. I mean, we really like the continued recovery theme in Chinese economy and also Chinese assets in 2026. It's not only, of course, the fact that any indication of a pickup in domestic demand could really help some of those better value stocks within the Chinese universe. But you still have that extraordinary backup in terms of the technology independence that China is trying to build. There's so many exciting individual stock stories as usual in China. So from that point of view, we believe that this latest pronouncement is very welcome and just reinforces our positive view on China in 2026.
So stabilization for the Chinese economy. What do you make of the risk from the property sector, because we're not seeing anything that China's doing differently to turn around this sector, which has been in the doldrums for a very long time.
Well, in some ways, this is surely the market solution. Destroying the stock of housing or to make more extreme measures in China would further perhaps skew the whole supply and demand issue. So allowing this situation to resolve with some supportive policy, I don't think it's right to say there's no supportive policy for real estate. We think that is something that will have to work its way through, but we are on that journey already.
We've been talking about, I guess, financial deregulation in China. To what extent do you think that can counter the PBOC's reluctance to cut rates?
Well, it's not, again, an unusual feature of Chinese policy that the benchmark rate is not, that doesn't tend to be the main policy lever that Chinese policymakers pull. The whole aspect of the supportive policies, both in the economic and the market sense, I think is what has been so important to the stock market's revival in 2025, and that is something that we continue to see. It is perhaps something that was missing in the earlier years of this decade, but now I think that the importance of the capital markets is coming back into focus, and that is something, again, which makes us more confident about the future for Chinese assets over the coming years.
So, Geoff, what are you excited about when it comes to Chinese assets? How would you position for 2026?
Well, as I say, there are always extraordinary opportunities within the Chinese stock market. Obviously, you have this rather interesting combination of those parts of the market which are still showing good relative valuation, those particularly obviously focused on domestic demand, but you also have the new technologies, the places within the stock market where you have which benefit from the focus on technology independence and security, but also, of course, the sectors and the continuing dominance of Chinese EV producers, for instance, where we believe that there will still be continued opportunities there. So I think that, as ever, China is something of a bottom-up story, but nevertheless, the opportunities are definitely still there for those investors that have that ability to seek out the hidden gems.
And, Geoff, it's not just China showing promise for 2026, right? The other emerging markets in Asia in particular are also good places to be parking your capital.
Well, I think that there are three main factors which we need to look at. It's not particularly profound or unique for me to say this, but you have to think about how the AI steam train is going to continue. You have to think about whether the Fed will continue to stimulate the economy through gradual but definitive interest rate cuts. And then, of course, you have the aspect of geopolitical tensions, of tariffs, of trade negotiations between different parts of the world. I think we're actually positive on all of those, which makes us positive generally on Asia as well, because you have significant AI themes playing out, of course, in places like Korea, in Taiwan, and in Japan to a degree in terms of the hardware supply chain. And, of course, further stimulus from the Fed should mean a dollar which is not particularly strong. It gives much greater flexibility for Asian central banks to stimulate their own economies. And from that perspective, that will be a further tailwind to these economies, but also, of course, the market as well. And finally, in terms of the overall trade picture, then I think that perhaps you are already having a reduction in the energy of the rhetoric coming from the US administration, and perhaps a reduction in the support for tariff policies, which we think is something that makes the outlook for Asia a lot more certain than it might have been a few months ago.
Geoff, we've been talking about divergence in central bank policies. Where do you see the biggest opportunities on the back of that?
I think it's across Asia. I mean, I think one of your previous guests was talking about India. India obviously is experiencing extraordinarily low inflation. This will enable the Reserve Bank to become dovish or become remain dovish over the coming months. But you see it across Asia, of course. The exception being Japan, but Japan, this is one of I think the evidence of the resilience of the global economy and markets that we've seen, that we do seem to be surviving the normalization of Japanese policy. And so from that perspective, we're obviously in line with the market. We expect there to be further rate rises from the BOJ, and that creates a different type of opportunity, because then obviously the financials in Japan are set to benefit significantly from that. So it's difficult to be too general, I think, about the opportunities. They vary from sector to sector, and they vary from country to country. But generally speaking, I think if you get your allocations right and you select the right stocks, then it could be a very good year for Asian equities in particular.
Geoff Lunt of HSBC Asset Management is staying with us. When we come back, we'll get more insights on tech as some investors pull back their bullish views on AI. More details just ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Goldman Sachs says its clients are taking a more cautious posture after November's stock rout. Its latest survey suggests institutional investors are pulling back their bullish view on AI and expect the S&P 500 to end 2026 between 7,000 and 7,500. That's a sharp retreat from expectations back in October. Wall Street veteran Ed Yardeni is another one cutting exposure to mega-cap tech stocks, telling us he's seeing a shift in earnings growth.
Profit margins have been awfully high from the Magnificent Seven. That usually invites a lot of competition, and that's exactly what's happening. We really have to view all companies, particularly the impressive 493, as technology companies. Everybody's using technology to make themselves more efficient.
Geoff Lunt, HSBC Asset Management, is back with us. Geoff, if you're underweight Mag 7, where else do you seek exposure to AI? Where in Asia would you do that? Is it just China or elsewhere?
Oh, gosh, no, it's not just China. I mean, as I mentioned earlier, even Japan, I think, has very high exposure to the hardware supply chain. But, of course, Korea and Taiwan is the amazing performance of those stock markets over this year has largely been attributable to that theme. So from that perspective, there are plenty of other places that you can look to invest in AI themes, whether it be in Asia or the global stock market. There are so many parts of this story, even just the implication for companies that are, I know that Mr. Yardeni has just talked about every stock being a technology stock, and I wouldn't disagree necessarily with that, but even those that are not labeled technology stocks, this is what it's all about, isn't it? Increased productivity. And so you have to be very discerning and very careful about your analysis in terms of really where you want to be position for this story. It's a fascinating conjuncture that we have at the moment.
As a whole, as a sector, would you still overweight tech? Because Yardeni says, no, he will not be overweight tech.
Is that what it's? I mean, I didn't see the whole interview. It suggested to me that he was being nuanced in his view. And from that perspective, not necessarily being short the Mag 7 may well be a legitimate investment strategy, but that doesn't necessarily mean that you're short of tech. We are quite reluctant, actually, to take a short position against AI in terms of an overall theme. And the reason for that is that we do believe that this is a revolutionary technology, that it will lead to extraordinary productivity gains. But of course, what we don't know and what nobody knows is whether the vast amounts being invested into AI technologies is going to, in the end, produce the returns that the investment justifies. So from that perspective, there are lots of unknowns about it. But being short of such an extraordinary phenomenon strikes us as the wrong thing to be just at the moment.
What's the biggest risk for all the assumptions that you're making right now, Geoff?
Right. Well, let me put it in a way that you might not expect. Perhaps the biggest risk that we're facing. And what I love about this is the fact that people are talking about AI being a bubble. People are talking about valuations. People are talking about being discriminating between the different parts of the market. From somebody who actually experienced the dot-com bubble, this is not the same as that. I think it's very, very positive, actually, for the market to be aware of these perhaps over-investments, which probably are taking place in certain parts of the market, and being discriminating about where they want to invest and having a range of views, not everybody being super bullish. I think that is a great thing. But let me put it this way, that the risk might just be that we're underestimating the AI phenomenon, that we're actually not putting enough emphasis on the revolutionary impacts of this extraordinary technology and the productivity benefits that it will bring, not just to the technology sector, but across the corporate landscape. So there you are. That's the risk that I would highlight, because it's the risk that fewer people are talking about.
How about AI proxies like clean energy? Because when you talk about the AI industry and data centers, we're talking about insatiable appetite for power. Would you be playing this space?
Yes, absolutely. But I would just emphasize how careful we need to be on this. And there are huge regulatory differences in different parts of the world, particularly when it comes to energy, because of the environmental implications that it has. So what we're seeing, of course, is already a very significant build-up of the clean energy infrastructure. That is costing huge amounts of capital to implement across the world. So we need to be careful about debt levels, for instance. We haven't talked much about bonds today, but we have to be cognizant of the fact that an awful lot of money has to be raised in the markets in order to finance these technologies, and not just the support of the AI infrastructure, but also the transition that we were already experiencing. So yes, there are opportunities within sectors such as this because of AI and because of clean energy, but at the same time we have to be quite careful about the amount of debt that is being issued and the sustainability of balance sheets in this context.
Let's bring bonds into the conversation since we haven't talked much about it, Geoff. When you take a look at your portfolio for 2026, is it still 60-40? Would you make any changes to that? Pivoting in any way at all?
Well, I think that our view on global interest rates is pretty much in line with consensus. So from that point of view, we think that inflationary forces are still present in the economy. We talked a little bit about the Japanese yield curve and how that obviously has, we've got 10-year JGBs now near 2%. So there's some upwards pressure on bond yields. It's not that we're super bearish on rates. It's just that we think that perhaps rates are more or less where they should be across the yield curve. And from that point of view, we do see perhaps a little better opportunities in the stock market. But our strategies are more nuanced than sort of being 65-35 or 60-40. It's the way you take your duration positioning. It's the way you take your sector positioning and your beta in each of these markets. So I wouldn't say we were underweight stocks and underweight bonds. I think what we would say is that we think the duration is probably fine,
right,
but nevertheless not very exciting. But that the stock market is giving you better opportunities.
Geoff, great insights. Geoff Lunt, Head of Asia Investment Specialists at HSBC Asset Management. Coming up, Knight Frank's APAC Research Head shares their forecast for China's troubled real estate sector. That conversation is next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. A duplex apartment has sold for a record price in Hong Kong in the latest sign the luxury property sector in the city is bouncing back. Hong Kong property stocks have bounced back this year from the lows hit back in 2024. That's as Fed interest rates have started to taper. Still, they're a long way below the glory days back in 2021. Let's get more with Bloomberg Finance editor Samson Alice. And Sam, what are the details of this sale that has improved the mood around Hong Kong property sector?
Well, Haslinda, as you say, this is certainly the latest indication that property prices in Hong Kong are bouncing back after a couple of difficult years, particularly in the luxury sector. So this latest property that changed hands is an 8,000 or more than 8,000 square foot property in the mid-levels west area of Hong Kong, overlooking Victoria Harbour that Hong Kong is famous for. And if I might add, the type of area where you might see Bloomberg TV's very own David Ingles roaming the streets if you're lucky. And this price of 880 million Hong Kong dollars, or as you said, around 113 million US dollars, is a new high for the city. It tops a penthouse apartment that was sold earlier in the year for around 600 million Hong Kong dollars. But both of these pale in comparison to the most expensive residential property sold in Hong Kong this year, which was a mansion up on the prestigious Peak of Hong Kong that went for 140 million US dollars. And in terms of the buyer, we don't know much about them as things currently stand. The transaction was conducted via company transfer, which is a common way for buyers to shield their identity. And of course, all of this is according to people familiar. Henderson Land, the developer and a sale agent for this property, declined to speak to Bloomberg for this story.
So, Sam, is Hong Kong property market back for good now? What does it tell us about the health of the property sector there?
Well, certainly too early to say if it's back for good, but it certainly are encouraging signs in terms of prices. After a couple of difficult years, Hong Kong property prices hit a peak back in 2021 when the city was going through, COVID and the lockdowns there. Since when prices have come down around 30%, but in recent months prices do seem to be picking up again. And it's not just in terms of sales. Home rents hit a record high in November, largely driven by a lot of new arrivals to Hong Kong, lured by the city's efforts to attract new talent to the city. Haslinda?
Sam, great stuff. Finance editor Samson Alice there. Well, let's get perspective. Christine Lee is APAC head of research at Knight Frank. Christine, what's your take on Hong Kong's property sector? How much conviction is there in this turnaround?
Yes, I agree with Sam. I think there are signs that the Hong Kong's residential market is poised for a recovery after a prolonged downturn. So home sales are staying strong. We see that it's being helped by some of the smaller and mid-sized projects and good sales from well-located regions. And that's also expected to keep transaction volume growing in 2026. We expect a 10% increase from this year, and prices are going to rise slightly by up to 5% next year. So at the same time, I think the rental market is also very strongly supported by the steady demand, like what Sam mentioned earlier, from foreign students, young professionals, and also talent programs like your Top Talent Pass. And some of the luxury rentals also saw some of the tenants from new economy areas such as your AI and the crypto. So some of these professionals are helping with the rental growth in Hong Kong.
So optimism, 10 to 15% upside from here. I'm just wondering, what will it take, though, for the Hong Kong property sector to get back to, its peak?
It's probably not at the moment. We are not really seeing the bottom of the market yet, because from the commercial perspective, we do see very muted demand for office sector, and there are still a lot of supply coming in. So this is creating a supply-demand imbalance, and I think hiring is still being selective. It's largely driven by financial services, maybe pockets of AI and crypto, but by and large, it's not going to support the current office market in Hong Kong for the next couple of years. So that it's a gap that needs to be filled. Even with young talents coming into the market, I think it will take some time to absorb all these office sectors, office vacancies currently, and that's also putting downward pressure on other sectors in the ecosystem, such as the retail sector. We do see tourists slowly coming back, but there are also competitions from places like Singapore or Korea or Japan. So Hong Kong has to work harder to get some of these tourists back into the market. And because of that, your real estate sector is still going through some recovery, some kind of hitting a bumps, and going to take a while for things to stabilize.
Christine, for most of us, it is about home prices. We're seeing high home prices here in the Lion City. How does Hong Kong compare, and what are you anticipating in the next 12 to 24 months?
In the Singapore market, of course, things are a little different because we have additional buyer's stamp duty that almost killed all the foreign buying. 60% is not a small number. On the contrary, if you look at Hong Kong residential market, they have removed all the cooling measures that have been in place for years. So currently, a lot of foreigners are able to buy those Hong Kong properties, and it's interesting to see that pockets of the buying emerged from high-end residential, from individuals, from companies who are still positive on the long-term prospect in Hong Kong. But I would say the buying is still opportunistic. You can see the current penthouse was transacted at a price that's 30% less than the peak from 2021. So there must be some, incentive for these buyers to go back to the Hong Kong market. So sentiment is still building up, but it's going to take a while.
It is, of course, about interest rates when we talk about the property sector. We've been tracking the headlines from the RBA. We have Governor Buller currently saying that, it doesn't look like additional rate cuts are needed when it comes to Australia. The RBA board didn't consider the case for rate cuts. I mean, will this influence and shape a market like Australia when it comes to, when you take a look at these rate decisions?
Yes, definitely. I think there has been a recent acceleration in the inflation, which has changed the whole outlook for next year for Australia, whereas previously most people were expecting further rate cuts. So now the market is really factoring in that potential for rate hikes. Clearly, this outlook is not that helpful for real estate sector compared to what we had a few months ago. It just means recovery will be a bit slower with reduced prospect of yield compression. But I think the story for Australia is a gradual recovery, which is still valid across all the sectors. But investors will still have to identify the opportunities with strong rental growth that drives return rather than just relying on the yield compression.
In terms of rental growth, what kind of rental growth are we anticipating?
I think for all sectors, particularly the office sector, has been quite well positioned for rental upside. So we are looking at the range, depending on the cities that we are talking about. Brisbane could be about 6%. Melbourne could be slightly slower, like 4%-ish. And Sydney is also doing quite well in the current climate because of the limited development pipeline that's going into all these key cities. And but the problem with some of the Australian assets is it has to be pretty cluster driven. So the focus is really on certain markets. For instance, your Melbourne is slower in terms of recovery, and the rental growth for some of the city fringe locations will be quite tough because of the impact from work from home is greater than other cities. For Sydney, it presents some opportunities in the North Sydney corridor because over there, it presents the largest, widest gap between the yield compared to Sydney CBD. So it really depends on where you're talking about. And in markets like maybe Brisbane, it is driven by your Olympics prospect. There's a lot of infrastructure building in the city, and the prospect for that city is likely to be boosted in the coming quarters.
And Christine, it is about capital flows, as we've seen in the equity markets as well. And we know that family offices and high net worth individuals are playing the property space in a huge way. What are you seeing in terms of how they're deploying capital in this sector?
I would say Asia Pacific actually had a very good third quarter because we do see some large portfolio deals coming back to the market. Even for Greater China, we've seen some data center investments by domestic groups buying something from foreign buyers because some of the foreign buyers want to exit the market. And in terms of investors' interest, they are definitely moving away from some of the traditional asset classes like your office and retail, but they are going into the alternatives such as your student accommodation and data center. So student accommodation is becoming a big part of the market, especially in Australia, because it offers steady income and it's less risky. So a lot of counter-cyclical plays in this current market.
What are the risks? And do you see risks from tariffs, for instance? People say that the full impact of tariffs will probably be seen in 2026.
Oh, because, even though the region's long-term real estate market is still expected to keep growing because of the strong long-term fundamentals, we do see the outlook could weaken if geopolitical and trade tensions rise in 2026, and that's going to create some market volatility and also slow down the cash capital flows. So we are really seeing how trade tensions impacted the first half of this year, and that is something that's really weighing on investors' mind. And apart from trade tensions, of course, interest rate and inflation are also other macro factors that will weigh on investors' mind when they deploy capital.
Christine, just one final question. What are you most excited about for 2026 for this space?
I think Hong Kong residential is quite interesting. As I mentioned earlier, the tenant base is also changed, and it's probably going to continue with this recovery. And for the office sector, I would say the developed markets, including Japan, South Korea, because of the sound fundamentals currently and low vacancy rates, they are poised for further rental growth in the near future.
Christine, thank you so much for that. Christine Lee, APAC Head of Research at Knight Frank. Just some headlines to tell you about from the RBA. Governor Bullock saying that she doesn't see rate cuts in the foreseeable future. And the question really is whether the extended pause or rate hikes. Now, a lot of the downside risks, she says, have already been abated. The upside risks have been generated. Again, this coming on the back of the RBA standing pat with its rate decision, keeping it flat for the third time running. Now, still to come, Japan accelerating its largest military buildup in at least 4 decades. Details of its plans for a missile archipelago next. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Japan is ramping up its military buildup across its southern islands as tensions between Tokyo and Beijing reach the highest level in more than a decade. It's also beginning to deploy major military assets, including F-35 fighter jets and long-range missiles. Let's get to Tokyo and our economy and government reporter, Yoshiaki Nohara. Yoshiaki, put this in perspective for us.
Sure. So, as you mentioned, that the tension has been rising between China and Japan because of the recent remarks by Prime Minister Takaichi on Taiwan. But the military buildup Japan is pursuing has been happening for several years, at least by now. And these are small islands, the camera clips, video clips just showed, are the places you feel the tensions in your daily life rather than just in meeting rooms or on a hypothetical sense. But these are places where people feeling the tensions already.
What else is expected as Japan looks to build up its military?
Well, two things going on. Japan has been always saying that it opens the diplomatic channels with China and making sure that the smooth dialogue is going on, which is increasingly getting difficult because of the recent spat with Beijing. But at the same time, they promised to the U.S. that they were expediting their efforts to build up defense capabilities, and they're already achieving making the 2% of the GDP for spending on defense. And that's a progress for the nation whose constitution remains unchanged. But the interpretation of the constitution has been changing, and I think there's a varying opinions in the public as well to accept to a degree the need for further build-up.
It begs the question what future plans are, because those residents are seeking clarity. How has the government been responding to their concerns?
One of the things that's mentioned in today's great story by my colleague Alistair Gale is that how the people are getting explanation and briefing from officials in those islands. But, I don't think there's been a very super clear instructions or clear answers to residents' questions because it's all up in the air. And a lot of things, the risks we are talking about, will depend on the individual specific circumstances. And the reason why we are seeing the flare-up in diplomatic relationship with Beijing right now is that the Prime Minister kind of indicated what would be the specific circumstances that would pull Japan into the risk situation over Taiwan, and that is actually bringing up probably more concerns than answers for these residents.
Economy and government reporter Yoshiaki Nohara, thank you so much for that. Meanwhile, the Indian government has advised its citizens to be cautious while traveling to China. That's after one Indian national was allegedly subjected to additional checks. The development has the potential to strain ties between the neighbors and comes as New Delhi continues to seek an elusive trade deal with the U.S. For more, let's bring in our Economy, Trade and Investigating Agencies reporter Shruti Srivastava in New Delhi. Shruti, what does India's statement on China mean, and what could it lead to?
So as you said that, an Indian national was detained at Shanghai airport late last month. And yesterday, the Indian government issued an advisory to citizens traveling to China. And it said that they should be cautious while traveling to China. Now, this is a sharply worded advisory which has been issued by the government. So the Indian who was detained last month was from the northeastern state of Arunachal Pradesh. Arunachal Pradesh is an area that is claimed by China as well. India has rejected these claims, but Chinese government last month said that there was no detainment of the Indian national, and this is an illegally occupied territory by India. The relationship between India and in China had only recently started normalizing, and this particular episode has the potential to further sour the relationship, which has started resetting only recently after a gap of 5 years. In 2020, after a bloody border clash, the relationship had gone into a deep freeze. But faced with Trump's tariffs, the two countries had started normalizing the relationship. After a gap of 5 years, they restored the direct flights between the two nations in October. This episode has the potential to basically upset that balance and maybe sour the bilateral relationship which the two countries have tried to normalize.
All against the backdrop of India-US relations. What's the latest on that, and what's the latest on the trade deal front?
So, there are two separate teams from the U.S. which are traveling to India this week. One is led by the U.S. Undersecretary of State for Political Affairs, Alison Hooker, who would be meeting senior officials here along with the Indian Foreign Secretary. And there is a separate team on trade, which would be traveling later this week to advance negotiations for a bilateral trade deal. Now, these two visits, again, they come in the backdrop of the fact that India is yet to see a trade deal with the U.S., despite negotiating since March. But officials in New Delhi say that these meetings they are basically an attempt by both the nations to bring the bilateral ties on an even keel. The relationship between India and US had started going south when Trump imposed a 50% tariff on Indian products going to the American market. Plus, the fact that the assertions by Trump that, he brokered a peace deal between India and Pakistan after a 4-day conflict in May, that had further soured the relationship between India and the US. Now, these meetings should be seen in that context. Officials in New Delhi say that these meetings are an attempt by both the nations to, restore and reset the ties. So, for instance, in September, the two nations conducted their annual military exercise. They also held the 2+2 intersessional dialogue. Just last week, they held a joint working group on counter-terrorism, measures. So both the sides are working to restore ties. However, despite all of this, while there has been a lot of positivity, a trade deal, there is no clarity on, timing of a trade deal. Only yesterday, Trump again made a comment and signaled that he could impose tariffs on India's rice. So we have no clarity on the timing of the deal. We all await the deal.
How much optimism is there in India that a deal could happen in the next 6 months, perhaps?
in the next 6 months. That's interesting because, the officials in India, they have been maintaining that, the first tranche of deal should be concluded by end of this month. But let's remember that that's something that they've been saying for a couple of weeks now. At the negotiators level, the India's Commerce Secretary, who's also the chief negotiator for the deal, he has been maintaining that at negotiators level, the deal has been, the last of the chinks have been, smoothened out. So, the two sides have largely agreed on a lot of contentious issues. And he also made a comment that now it's the call of political leadership to essentially, signal the timing. So I think the optimism on Indian side is huge. But yesterday's comment, they sort of bring that lack of clarity on the timing.
Shruti, thank you so much for that. Our Economy, Trade and Investigating Agencies reporter Shruti Srivastava in New Delhi. Now, RBA Governor Michelle Bullock is holding a press briefing after keeping rates unchanged. Some of the headlines to tell you about. She talks about how the RBA board is uncomfortable with the level of inflation, which remains sticky. She says when things change, you have to change your view against this backdrop of questions of whether or not the RBA will raise rates in 2026. Governor Bullock also talks about how she doesn't see rate cuts in the foreseeable future. The question is whether the extended pause will be maintained or that we will see rate hikes. Well, keep it here with us. This is Bloomberg.